Well, the management decision many times facing is whether should we buy something or leasing something. So like, should you buy your house or you're going to rent your house? Similar decision like that. So obviously we understand what would be the implication of buying a home versus rent a home. Buy a car versus lease a car or buy a car using finance. This is what we're talking about. When we talk about leasing from a business perspective, we have two different types of lease, and accounting treatment for those two different leases are different. For those of you already taking the financial accounting, you understand what I'm talking about. I also assume that you understand the differences between operating lease and the financial lease. So I don't want to spend too much time. This should be part of your financial accounting classes. If you have not taken financial classes, you can quickly Google or ask AI to tell you how they are different. All right. So how should we decide whether or not we should lease or we should buy? Well, here is basically the decision comes down to whether which one gave you the lower discount, which one gave you the lower present value of cash outflow, then that will be the one you should go about. Or if a project will generate positive income, then you can say, okay, because it doesn't matter whether you buy or you're leasing it, the assets that you are using to generate income is still the same. Now, I mean, the amount of income is still the same because assets is still the same assets. It's just the car you're driving is still your car. It's identical car, but you could buy it outright, or you can lease it for 3 years, or you can take it on a loan and buy it. Okay, so the only difference is cash outflow. What they are saying here is decision should be based on discounted cash outflow, and then you should select the one with lower present value of the cash flow, net present value, NPV. Okay, so how do we calculate what are the cash flow implications of operating lease versus the financial lease? This slide lists the difference between the operating lease or financial lease. All right, and how you calculate them differently. All right. So let's take a look at the example of the calculations. So in this case, we have this corporation. You have an option to acquire a new machine with 5-year leasing, operating lease, or to purchase outright. So the machine will increase unit output for an after-tax incremental profit of $50,000 in year one and $70,000 in year two, $70,000 in year three, and $100,000 in year four and year five. The lease rent, which is a lease payment, is $90,000 payable, and you are paying at the first day of each year. You use straight line depreciation, which is acceptable under both financial tax accounting. The tax rate is 40%, and the weighted average capital is 11%. That means that you use 11% to do your discounted cash flow. So what is the net present value of leasing the new machine? In this case, they're not asking of the net present value of leasing the payment. We're looking at the net present value of the new machine. So we should not only incorporate the outflow, but also the inflow. So this is different. If they ask you what's the net present value of the leasing payment, actual leasing payment or leasing option, then you only do the outflow. So what is the net present value of leasing outflow? Then you'll do in this case, we're doing the both inflow and outflow add together. So we do the net present value of the net cash flow of the to lease this particular new machine. All right. So let's see how we calculate this. So basically, you can see here the keywords here is the you make payment at the first day of each year. So for net present value concern, then you basically consider the first payment was made at period 0. All right. So you have $90,000 cash flow for the year 0 because at the beginning of the first year. All right. And you discount it back, there's nothing happens. So the discount, the net present value of that $90,000 is $90,000. Okay. And for the second payment outflow is at the beginning of the second year, but that's the end of the first year. So this $90,000 is going to be only discounted by 1 year. So that's why I'm putting at year 1. So on year 2, year 5, sorry. Year 5 has no cash outflow. Okay. And year 10 here should be so this will be 100,000 profit instead of 100 typo there. So this is you only have 5 payments. 1, 2, 3, 4, 5. 5 payments, okay, for the 5 year. So basically, this is how you calculate. So you get inflows here. You have tax savings, all right? Tax saving from here. This is a cash outflow. So it's 1 minus tax rate. So the tax saving is this is 40%. Sorry, right here. This is the answer. So the tax saving is 40%. Okay, because that's the tax you would have paid, right? If you don't lease, you don't make this $90,000 payment, you don't acquire this machine, then you don't have that expense, you don't have that outflow. It's an operating lease, so it's no depreciations. So just a payment. So the payment you made is tax deductible when your tax rate is 40%. So the saving is $36,000. So that's considered cash inflow. So total inflow is 50 plus 36,000, but you have the minus at the beginning of the year, you paid 90,000. Your income is made off at the end of the year, and the tax savings at the end of the year. So this is year 1 inflow, but year 1, first day of the year 1, you have outflow. Okay, I only discounted 1, but that's the second payment is coming for 1 year because, again, I explained it. For the first payment is the beginning of the year, the first year, which for discount, that's only 0. There's no discount because that's the same day, all right? So the net cash flow is like this. So with these different net cash flow for each year, then you calculate net present value, use the net present value, either use Excel or net present value table, then you should get this one, 4290, all right? So the correct answer is A in this case. The next question. This is a 5-year project. You either buy the machine without borrowing $50,000, so you pay $50,000 outright, or you can enter 5-year operating lease for annual payments of 105 and an estimated life of 5 years, and you can sell this machine for $15,000 at the end of the year, and then your average tax rate is 30%, and then your projected discount rate is 6%. So what is the relevant cash flow? The net present value of net cash outflow of operating lease. Remember, this is different from prior question. The prior question is asked what's the net present value of the leasing the new machine, which leasing the new machine will generate positive cash flow, but we also make outflow of $90,000 payment. For this question, we're not asking for the outflow. For this question, we're not asking for the net present value of the leasing new machine. We're asking the net present value of the net cash outflow of the new machine. All right, so that's different. So the after-tax payment it should be equal to, so after tax payment, as the formula is, so we pay 105 times 1 minus tax rate of 30%. So that would be after tax payment, each payment year is 73,500. You can do the math. And then since our discount rate is right here for each year, so then basically you will have, so the outflow, the net present value of payment outflow should be equal to, like, the first year we discounted it for factor of 0.943 plus the second year of 73,500 discounted by 0.89. So this basically you can do the math. All right. And then we come up of 309,582. That'll be our answer. This one is a conceptual question. So relevant cash flow for a finance lease and direct purchase of assets without borrowing. So there are two options. So basic question is, how are they differ? Well, A, depreciation tax shield and after-tax salvage value of the assets. B, tax saving on interest expense and after-tax salvage value of assets. C, the tax saving of interest expense and purchase price of assets and the lease payment, and depreciation tax shield and tax saving on interest expense. Well, you can see here, if we buy outright without borrowing, then we don't have savings on interest expense. So that is certainly something that differs between the two. So we can eliminate. So any choices here without including the interest expense, savings or interest expense is not correct, because that's the one that differs between the two. So A is not correct. So we eliminate them. But B, we have tax savings. C, we have tax savings of interest, and D, we have tax saving interest. So which of the three is correct then? Well, we can see that. So this one, what about, so we'll look at the tax saving, the after-tax salvage value of the assets. Are they different between the two? No, it doesn't, because you are doing a financial lease, in this is a finance lease. So the ownership was change hand. Remember, finance lease, we have our ownership is change hand, if you understand what's the difference between operating and financial lease. So when your ownership change hand, then both options, the lessee, the one that acquired the assets, will ultimately enjoy the after-tax salvage value, regardless which option you are going. You buy it outright or you do a financial lease. Doesn't really matter. Same thing with the depreciation tax shield. In both situations, you whether you use a financial lease or a purchase outright, the lessee has the ownership. So the depreciation tax shield are enjoyed on both scenarios. So that's no difference. So D is not correct, B is not correct, and C is correct, because one has leasing payment, the other does not have leasing payment. One have the tax saving interest expense on the interest expense, the other does not have tax savings on interest expense, and the purchase price can be different when you buy outright paying cash or you're doing a financial lease. Okay, thank you.